This podcast is general in nature and hasn't taken your circumstances into account. It's important you consider your personal circumstances and speak to a financial advisor before deciding what's right for you. Any general tax information provided is provided as a guide only. Now, here's Shane and Deanna.
G'day everyone, welcome to this week's edition of the Simplifying Investing podcast. G'day Deanna.
Hey Shane.
Not another week, another inflation report in Australia. Not such good news, unfortunately for us. We were expecting it would go down, it actually went up. I guess the question is, how worried should we be?
So if you look at the monthly data over the month of April, inflation was up by about 0.7%, 3.6% year on year, a bit stronger than the consensus economists were forecasting as well. I mean, it is the monthly data, and we know that the monthly data is not a full accurate read of every single basket of goods and services because not everything is surveyed. So a lot of the goods are updated in the month of April, but a lot of services aren't. So goods prices can be quite volatile month by month for things like fresh food, meat, seafood, energy, petrol prices. And in the month of April, there was a big one-off rise in some fresh food for things like berries, although I haven't noticed that myself. My strawberries and my raspberries are still costing me the same.
Vegetables as well, I saw.
And vegetables and health insurance.
Must have been some weather event.
Yes, that's what the ABS said. And health insurance premiums went up a lot more than expected, or a lot more than they have in recent years. So a few volatile items, but I guess the overall story is that this disinflation that we've been seeing, so this decrease in inflation in the past few months, has really stalled, both across goods and services. So we really need to see inflation come down to the top end of that target band of 2 to 3% for the Reserve Bank to be comfortable with eventually starting to cut interest rates. I mean, I don't think that the numbers today were too far out of line with the Reserve Bank's forecasts. They've got 3.8% year-on-year inflation forecasts for the June quarter. I mean, that still seems like we could reach that level.
I guess the other thing, at the same time, we've had very soft economic data in Australia. Of course, this bounces around a lot, but we got retail sales only up 0.1% in April. That was after a 0.4% fall in March, after the so-called swift lift in February, which was just 0.2% rise. So overall, pretty weak retail sales. And then construction data fell pretty much across the board, which sort of put those two things together, construction and consumer spending, big chunk of the economy, pointing to pretty weak economic conditions. And of course, we all know that historically anyway, inflation tends to lag the economic cycle. Growth goes up, a little while later inflation goes up. Growth goes down, a little while later inflation goes down. So you can make an argument that, given that, the trend is still down in inflation.
But I guess a lot of people will be worried that this is higher than expected. We're not seeing further slowing in inflation. Could we get a hike in June?
I don't think so. I noted in the minutes from the last RBA meeting that they sort of argued, well, and in fact in the press conference after that meeting, that, they did consider hiking again at their May meeting, but they concluded that, amongst other things, that they'd already done enough. I tend to think, and this is based on a chart that you've put together, when you look at Australian mortgage rates, that the rates people are actually paying, they've gone up massively in Australia compared to far more modest increases in other countries that have seen bigger increases in their cash rates. So actual monetary policy, you could argue, is tighter in Australia than elsewhere. And of course, the other factor is the Reserve Bank in their minutes noted that they should resist jumping around in response to every variation in inflation, resist the temptation to fine-tune and become what I would call, or Milton Friedman once called, a fool in the shower. That's someone who just constantly tinkers with the taps, not waiting for the lags from the hot to the cold, and therefore ending up going from boiling hot to freezing cold in the shower. So I tend to think that they would say, well, let's wait for more data, particularly to your point. The RBA's forecast for inflation for this quarter is 3.8%. This is 3.6%. So you could argue, well, it's consistent with that.
And then I guess we've spoken about this before. If we did see a hike in June or even later this year, I mean, would another hike even help some of the areas that are seeing some of the fastest growth rates in inflation, like health, education, insurance? Aren't these all just areas or categories that have seen that delayed inflation impact? Maybe all states should go down the path of Queensland of introducing 50-cent public transport for 6 months. Then we could see lower transport prices.
Well, maybe that is an argument. This is where economists get themselves tied up in knots. Many economists say, well, we've seen this fiscal stimulus pumped into the economy. extra government spending funding the cost of living measures. Others sort of say, well, you've got to allow here that if you cut public transport fees to 50 cents or you give people $300 off their electricity bill, they don't actually get the $300, it's just off their bill, then that will get down measured inflation. And I must admit, I have a leaning to that view. I don't think the amount of stimulus in the budget was enough to sort of pump the economy up, but I do think those measures will have an impact in getting inflation down. And you could argue, well, a lot of those areas you cited, education, health, are somewhat affected by government-related decisions. So if government then makes a decision to lower the cost of other things, and that lowers measured inflation, then surely that's a good thing. And of course, you've got a bit of a flow-on effect because many items out there are actually indexed to the inflation rate.
Yep.
So if you get an inflation rate which turns out to be 3% rather than 3.5% because of government measures, then that has a flow-on effect as those indexed increases slow down. It also helps keep down inflation expectations. Workers say, well, that's a lower inflation rate, therefore I'm going to ask for a wage rise that's 0.5% less than I otherwise would have wanted. So I'm not too fussed by those measures. In fact, I think they do make sense. Now, of course, you can't take it to an extreme and cut the price of everything. You could make an argument, well, if we subsidise every item out there using government spending, we could get inflation to zero. That you can't take this to that extreme. It won't work. But at the margin, I think it does help. And I think we've had several occasions several conversations about this, and a few of them you mentioned that various European countries have done something like that, and it seems to have helped over there. So I think that's another thing you need to allow for in the second half of this year. Those reinvigorated cost of living measures, including the urban transport fares in Queensland, they will impact through the next 6 months, probably pulling the headline rate down below current levels and I think well below the Reserve Bank's 3.8% number. I guess more broadly, in the last week, you put out a note on inflation globally. What are the key messages there?
So I guess I wanted to update our readers about some of the trends that we're seeing globally, and there has been some concern that the disinflation path globally has stalled as well, and you can kind of see that in the US consumer price and producer price data that it's sort of remained fairly unchanged around 3.5% or so in the past few months. And there are some upside risks to global inflation. More recently, we've seen commodity prices, particularly for metals, go up quite a lot. That doesn't necessarily flow through directly into consumer prices. Just because the price of gold goes up doesn't mean that producers have to pass that on necessarily. But I guess that if you see this broad-based rise in commodity prices that flows through to producer prices because of things like better global growth, then you could see some increase to inflation. But based on the other leading indicators for things like the PMI price surveys, wages growth around the world, those are still looking pretty good. So I think that our view that inflation will continue to slow this year still looks reasonable. And the only way that I suppose we would need to change our forecast would be if you saw a much broader rise in commodity prices that was then passed through to consumers. And I just don't think that we're there yet. So the next move for central banks to me still looks like it will be a rate cut across most of the world. I mean, obviously some central banks like the People's Bank of China is still going to be raising interest rates. But in the developed world, for countries like the US and Australia, I think rate cuts are still going to be on the agenda.
The funny thing is we've now seen two major advanced countries cut interest rates, Switzerland and Sweden. It's quite possible by the time you watch this or see this podcast, Canada may have cut. They have a meeting coming up in the next week, so they may cut. And then you've got the ECB the day after, they may cut. So the broad trend globally is still towards lower interest rates, but I kind of think, well, the road to lower inflation was always going to be bumpy. It wasn't going to be squeezed out of the system in a brief time. It's obviously been more bumpy than we would have thought, but I think we're still on track for lower rates.
And this week you put out a note about the US election, which is coming up in November. What are some of the key takeaways for investors and when it's hard to sort of predict right now who's going to win, given that the betting markets are pretty even?
Yeah, they are. I mean, the interesting thing is that Joe Biden is lagging Trump by 1 to 2 percentage points, both in terms of favourability rating and in terms of voting intentions for the election. Whereas in contrast, in the 2020 election, he was well ahead or ahead of Trump. So that is a concern for the Biden camp. I guess, you're right, still a fair way to go. This is heading into June and the election's not till November, so those numbers could bounce around a lot. It's also the case that what the US economy does is critically important. Since 1932, it's basically determined whether an incumbent president gets re-elected or not. For those presidents who saw a recession in the last year or so prior to the election, they lost. For those who didn't, they were re-elected. And of course, Trump was in the former camp back in 2020. And of course, you've still got a big chunk of undecideds in the US. Something like 14% of voters are undecided, and 20 to 25% of Trump supporters say that they may reconsider their vote if he's convicted of a criminal charge against him. So there's a bunch of things that could still spin this around, but obviously it's critically important for investors. I get a little bit nervous about it because last time around when Trump was president, my son kept joking that if I comb my hair a little bit lower down here in terms of the part, I could look like Donald Trump. So I'm not looking forward to that joke coming back, although I should point out my part is still a little bit higher than Trump's is. But anyway, apart from that, there's other issues with Trump as well. Apart from that, the big policy differences are quite significant. They're in the areas of taxation. You're going to get lower taxes under Trump than under Biden. Even if Trump does absolutely nothing, taxes will in the US go up in 2025 as the 2017 Trump-era tax cuts expire.
And what about all the tariffs that Trump wants to put on?
Tariffs are probably the big one, and that will impact Australia. Trump has talked about a 60% tariff on China and a 10% tariff on all imports going into the US. And the rough maths is that will push up the average tariff rate in the US from about 2.5%, 3% up to 17%. This is a massive number compared to what you saw with the first round of Trump back in 2018, 2019, when the US average tariff rate rose to 3%, particularly on China. So that would have implications for US inflation because it's such a big increase. For global trade, other countries would probably retaliate. Australia would be vulnerable. There was an OECD study showing that a 10% reduction in global trade between countries would result in something like a 1% hit to our GDP, which is the second highest hit in the OECD countries after Korea. So we are vulnerable. He also wants to cut back immigration levels, which means less labour supply in the US. They're threatening to curtail the independence of the Fed. And of course, on the other side, more deregulation. So far, I think investment markets are sort of either ignoring it or where they are focusing on the possibility of a Trump victory, they're focused on the positives, lower taxes and deregulation. But at some point in the next few months, I think markets may start to worry more about the impact of return to more severe tariff wars, the curtailment of immigration in the US, and threats to the independence of the Fed. So it could give us a bit of a volatile ride in the run-up to this election. Historically, I know Trump won back in 2016 and the US share market soared almost 40% going into early 2018. Of course, that was a little bit different because he prioritised through 2017 the tax cuts. It was only 2018 he started to talk about tariff cuts. So obviously the relative weight he gives to and the focus on the different policies, the positives versus the tariff hikes and so on, that will impact quite significantly in terms of the market reaction. And of course, just to sum up on all of this, it's still many months away before we have that election, but it is rapidly approaching.
But if you look at what happened to the US in 2018 after Trump 1.0 and the tariff wars, I mean, do you think it had a big negative impact to the US economy and to share markets?
I think it did on share markets, but the US economy, I don't think it was a major factor. It did cause disruption and uncertainty. Share markets don't like policy uncertainty, and policy uncertainty rose through the Trump period. And you can see each time he made these tariff announcements, even though you could do the maths and say, well, it's not a huge chunk of US imports, it did have an impact on the US share market. And through 2018, from the high in April, I think it was 2018, to the low on Christmas Eve, 2018, the US share market fell something like 19.9%. Now, of course, the Fed was raising interest rates at the same time, so that was another factor, but the trade wars certainly didn't help. If you look back on it, it wasn't a disaster, probably because Trump then pivoted towards the phase one trade deal with China, and he cut free trade deals with Mexico and Canada and seemed to settle his dispute with Europe and so on. So The question is whether he'd do the same thing this time around, because back then he wanted to get re-elected in 2020. This time around, assuming he doesn't change the constitution, I don't think he can, then he can't get re-elected again. So there's no political constraint on him adopting a far tougher stance in terms of the tariffs. So yes, 2018, that period wasn't a disaster. The US share market did well in 3 out of the 4 years when Trump was president, exception being 2018. And so maybe we'll get through it okay. But I suspect the uncertainty will be a lot higher this time around because he won't have the same political constraints.
And I guess some people might argue that the trade wars with China allowed the US economy to grow its own manufacturing and investment base, grew more US jobs. I mean, it's hard to really know how much of that was related to just the post-COVID boom that we had and how much of that was actually due to domestic jobs being engineered rather than going to China.
Yeah, we'll never know precisely, but there's no doubt that period has ushered in a greater geopolitical uncertainty. The COVID period led to a desire by countries to shore up their supply chains, not being reliant on other countries. So that's led to a boom in manufacturing employment in the US. But as you imply there, a lot of that was propped up by subsidies and things, so you don't know how viable it is long term. And of course, it'll be interesting to see how Trump responds to all of that, because a lot of those subsidies are in relation to green manufacturing. Trump is threatening to unwind a lot of the Biden policies which have boosted green manufacturing and curtail electric cars, for example. So there's a lot of uncertainty around that. There's also the short term. If you put tariffs up, you get a short term boost to local manufacturing, but you get some long term damage because you're not relying on on goods from the lowest cost producer globally. I guess my view would be if you're worried about geopolitical threats, then you rely more on your friends, say Korea or something. It doesn't necessarily mean you put up a tariff war yourself and then make all the stuff. You just make sure that you get more diverse supply chain in the process.
Well, that's it for today. Thanks, everyone, and thanks, Shane.
Thanks, Diana. Take care.
For more info on Shane and Diana's podcasts and reports, head to the Insights Hub at amp.com.au.